The latest quarter showed Google is taking the lead in AI, investing $85 billion in 2025 alone into large language models, cloud infrastructure, and data centers. It will quote-unquote impact every part of the business. But these investments don't come cheap. Fierce competition from Microsoft, OpenAI, and more are pushing up AI investments to astronomical levels. The question is, can Alphabet even afford this? In this video, we'll break down Alphabet's fundamentals, from revenue growth and profit margins to buybacks, dividends, and debt. We'll also take a deep dive into Alphabet's economic moat to find out whether its dominance is still defensible in the age of AI, before scoring the entire business from 0 to 100. Let's start with the income statement. Alphabet's revenue has more than quadrupled since 2016, climbing from $90 billion to a projected $371 billion in Q2 2025. And it's not just revenue. Gross profit and net income has kept pace, which tells us the core business remains highly efficient. And down here we can see that analysts forecast revenue to grow 12%, with net income expected to grow slightly faster at 13%. Now let's visualize the growth trends. Revenue growth peaked in 2021 at over 40%, but has since slowed, and you can see that clearly in the green bars. Recent years' growth has been 9.8%, 8.7%, 14%, and 6%. The moving average trend line is heading downward, signaling deceleration. However, that's not the whole story. Check out the blue net margin line. It's steadily increasing from around 21% in 2021 to over 31%. That means Alphabet is becoming more profitable even with this slower growth. The 5-year CAGR numbers also support this. EPS is up nearly 22%, and margins are growing over 7%. So while growth is stabilizing, profitability is improving. Here's where Alphabet's money comes from. The US still dominates with 48% of revenue, followed by Europe, Middle East, and Africa at 29%, and Asia Pacific at 16%. While revenue across all regions is growing, the US clearly remains the company's stronghold. By the way, you can check out my previous video on Alphabet's business model, competitor analysis, and insider trading activity by clicking the link in the corner. Let's talk about one worrying sign. Alphabet just raised its capital expenditure forecast for 2025, now expecting to spend $85 billion, up from $75 billion. That's a 62% jump. Why is that? The answer? Surging demand for Google's services, especially cloud. So the company is investing more into cloud infrastructure and AI, using this as an opportunity to grow. CEO emphasized AI as a multi-year growth driver, but while good on its own and positions Alphabet for long-term growth in high-demand segments like AI and data centers, this aggressive investment would weigh on short-term margins. When we compare Alphabet's revenue growth to other tech giants, it holds up well. Over the last 5 years, its revenue has grown 109%, better than both Apple and Microsoft, but trailing Meta and Amazon. Alphabet may not be the flashiest growth story here, but it's solid and consistent, which matters for long-term investors. EPS tells an even stronger story. Alphabet's earnings per share have grown 246% over 5 years, nearly on par with Amazon and Meta. That's a major acceleration. It's a strong signal of operational efficiency and profitability, even in the competitive space Google operates in. And could AI maybe supercharge this even further? I'm interested in your thoughts. Comment down below. Let's break down Alphabet's economic moat, starting with switching costs. Google isn't just a search engine. It's tightly woven into users' daily lives. For both individuals and businesses, moving away from these ecosystems means lost productivity, retraining, and rebuilding workflows. That creates a strong user lock-in function. Next up is the network effect, and it's massive. The more people uses Google services, the more data it collects, which improves algorithms, which in turn attracts more users. This cycle fuels everything from search relevance to YouTube recommendations to Gemini, their AI assistants. It also gives Alphabet an enormous advantage in training future large language models. According to Morgan Stanley, AI could even increase engagement further. Now let's talk about economies of scale. Alphabet already has the infrastructure, the data centers, the global cloud backbone, and the ad tech stack to serve billions of users. That kind of scale means it can run operations at lower marginal cost while reinvesting it in growth like AI, cloud, and hardware. This also gives Google huge barriers to entry, along with legal and regulatory complexity, which adds an extra layer of protection. On the intangible assets side, Alphabet's brand is globally trusted and instantly recognized. But more importantly, it holds unmatched user data, and since it organizes the world's information, has a head start in the AI race. So when we add it all up, powerful switching costs, a massive network effect, and irreplaceable user data, Alphabet earns a solid wide moat rating. Alphabet's total assets have increased from $319 billion in 2020 to just over $502 billion by Q2 2025. That's a compound annual growth rate of 9.45%. Now, what's more important is how they have funded that growth, and it's mostly through equity, not debt. Equity has grown from $222 billion in 2020 to $362 billion today, representing a healthy 10.3% CAGR. Meanwhile, liabilities has grown at a slower pace, from $97 billion to $139 billion, or about 7.47% CAGR. This trend tells us Alphabet isn't really relying heavily on debt to expand. We can see this in the declining debt-to-equity ratio, which has dropped from 0.44 in 2020 to just 0.38 today. Alphabet's conservative balance sheet stands out among its tech peers. Apple and Meta, for example, both have more debt, and Amazon has overall higher CapEx and thinner margins due to this. Alphabet's net debt is almost non-existent, just $2.5 billion. That's because cash and equivalents nearly equal its interest-bearing debt. The bankruptcy probability? A mere 1%, with a solvency score of 81 out of 100. This is from AlphaSpread. It's about as financially secure as a company can get. But even Alphabet has its limits, and AI infrastructure doesn't come cheaply. Increasing AI investment could lead the company to take out more debt and leverage the company. Let's talk about share buybacks. Alphabet currently has a buyback yield of 1.77%, meaning it's returning nearly 2% of its market value to shareholders through stock repurchases. Over the past 5 years, the number of shares outstanding has steadily declined, down from around 13.9 billion in 2018 to just over 12.2 billion today. That's a compound annual reduction of 2.22%. Alphabet repurchased over $16 billion of shares in Q2 25 alone, and has a new $70 billion buyback authorization in place, reflecting strong confidence from management. Dividends. Alphabet's dividend journey is just beginning, but it's off to a strong start. The company initiated a dividend in 2024, paying $0.6 per share, and by Q2 2025, it's already grown to $0.18. That's a 35% year-over-year increase. Even though Alphabet's dividends yield is still low at 0.42%, the 5-year growth rate stands at a strong 35%. And it's doing this with minimal risk. The payout ratio is under 9%, meaning only a small slice of earnings is being used. They should be able to keep paying dividends, even with increasing CapEx. The dividend safety score from AlphaSpread backs this up, rating it a solid 63 out of 100. I've graded the dividend policy as okay for now, mostly due to the short history of dividends and the low dividend yield. And the question is, can they really continue paying dividends and also buy back shares while investing into expensive AI? Here we're looking at how efficiently Alphabet turns its resources into profit. Return on assets is 23% and trending upwards, showing solid use of its assets. Return on equity is also improving, now at almost 32%. But the standout here is return on capital at 38%. Compared to peers, this is exceptional. For reference, Apple is around 32% and Microsoft about 27%. Alphabet is putting capital to work more effectively than most of its big tech rivals. Overall, these three efficiency metrics are either holding steady or moving upward. Now let's wrap things up by looking at the full picture, starting with sales, which scores 75. Revenue is up 15% annually, with EPS growing faster at 26%. Net margins are also expanding, which is really good, and it's a steady, profitable growth story. Next is efficiency, a perfect 100. Return on capital is an outstanding 38%, which is better than both Apple and Microsoft. Debt also scores 100. The DE ratio is just 0.38, and the current ratio is nearly 2. And Alphabet could easily pay off its debt in just 2 years. Payback is the weakest at 56, but this is still improving. Shares are down 2.22% per year, and dividends are growing fast, though the yield is still pretty low at 0.42. On the right, we have the business model, scoring 91. Every component from value proposition to competitive advantages scores either stellar or good. This reflects Alphabet's wide moat, optionality, pricing power, and position at the center of major tech trends like AI and cloud. If you want a deeper dive into these elements, check out the business model video I posted earlier. Let's also look at pros and cons. On the pro side, Alphabet utterly dominates in search. It's a leader in AI and has a scalable, highly entrenched business model. It enjoys a strong moat and operates with a high degree of optionality. On the con side, there's a growing threat from AI, potentially disrupting search, forcing Google to increase R&D and CapEx investments. We also have persistent regulatory and antitrust pressures. Lastly, the company also faces intense competition across nearly every single segment it operates in. Bringing all of this together, Alphabet scores a total of 84, placing it in the stellar category. Can Google really keep growing, rewarding shareholders, and leading the AI race, all at once? If you got thoughts on Alphabet's future, drop a comment down below. I'd love to hear your take. And if you found this breakdown helpful, consider liking the video and subscribing for more in-depth company analysis like this.